Holy smokes, not even life insurance prevented the disaster that we just had in CPI. This is bad. We basically just fully unpriced the March rate cut. The odds of a May rate cut have been reduced to about a third. We've got now maybe a full rate cut set for July. And we'll go through what happened with the numbers, but what I think is most important here is I think the Federal Reserve is gearing up for... We got to get past January, which, as Goldman Sachs says, which I believe as well, could be your January kind of price hike. A lot of personal services, hiking prices in January, funeral services, accounting services, financial services, veterinary services, medical care services. I mean, across the board, we saw services really move up in January, which was unfortunate because, one of the things JP Morgan warned us about was that if we got a read of somewhere around 0.3 to 0.4, we would really be concerned about potentially this core reacceleration of inflation. And that's exactly what we got. We were looking for 0.277 on CPI core month over month. That's what we were looking for. We ended up getting 3.9. Well, I shouldn't put it as 3.9. It should actually be written as 0.39. There you go. But the point is, that's quite hot. If you annualize that figure, just sort of on the monthly basis, which is you multiply it by 12, you don't go exponential, you're at core inflation of 4.68%. But what's worse was supercore. Supercore came in so hot and is to some extent re-accelerating that some folks are wondering, oh no, is this exactly what the Federal Reserve fears? Remember, I throw this all over at ehack.com. Check it out, ehack.com. But what do you have here? And what is this going to mean for the election as well? We'll touch on this. But look at this. This is a chart of supercore inflation. The Federal Reserve wants to see inflation come down meaningfully. We really want to see supercore inflation probably settling somewhere around higher in the twos. That way you can get goods disinflation drag you down. But what you actually have here is a reacceleration of super core. We have not seen a super core this super bad in 2 years. And I'll tell you, there's almost zero doubt that today, whenever Donald Trump is awake, we're going to be getting some Trump Truth Social posts about how bad inflation is and how it's essentially getting worse. And at the moment, Donald Trump is going to have a leg up in using that as a weapon. He's going to use that as a political weapon because, of course, why would you not? That's what we're dealing with right now. So the question then is, why? Is it possible that this is just a January number? Well, we have to balance that out. First of all, we get seasonal adjustments in January. So if this spike is just a January spike, we actually have to have more of a January spike than we had in prior months, or I should say prior years, right? Because if every January you have a spike, well, that gets seasonally adjusted away. If this January, which was a warmer January, you get a larger price hike above your seasonal adjustments, you end up getting this kind of reacceleration. We also, as we went through the actual CPI release, we wanted to see, hey, were these numbers hot because of potentially weak seasonal adjustments? And as we were going through the actual item page by page over here, we compared the red highlights to the orange highlights. The orange are the non-seasonally adjusted numbers. The red are the seasonally adjusted numbers. The numbers were not that different, which is a sign that no, this was not an issue of adjustments. This was just an issue of broad-based inflation, which is not good. Again, it could be hot January, people spending money in January still more than expected, but it is going to be a political hot potato that Joe Biden has to deal with. And I'll tell you, after Kamala Harris yesterday suggests, hey, make sure you remember the warrants have been called for house hack at househack.com. No, that's not what she said. Kamala Harris yesterday said, I'm ready and fit to serve. A lot of people are scratching their head going, wait, this after the DOJ report on a decline for Joe Biden? Wait, is this the plan? Are we voting for Kamala Harris as president? Anyway, sorry, that was sort of a little side note. But basically, CPI is a very important measure. which folks will look at for when it comes to voting, because inflation really frustrates people. We even had grocery prices tick up again in January. Now, that does come at the same time as GDP is sitting at 3.4% on its current estimate for Q1, the first quarter, the first 3 months of the year. This is great. This is a great sign that the economy is doing well and moving strongly. But prices are still moving up at an unacceptable pace. And it's a broad-based spread, too. You can see some more of the details that we've thrown over at ehack.com, but it's a broad-based spread. It's various different categories. So the question now is, what does this mean for the Federal Reserve? A lot of folks come here to see my opinion on the Federal Reserve, and I'll tell you, I think here's exactly what the Fed is lining up for, okay? Look, March 20th only gives you the January and February CPI reports. That's not enough. If January is going to be a one-off and hot, you're really going to need 3 to 4 CPI reports to argue that January is hot and everything else is not. That's the only way you can argue that. So May is going to give you January, February, and March, but that only gives you 2 to balance out one hot. Probably not enough. You're probably leaning towards June. That way you can get the summary of economic projections in March. And June 12th is a really special day because you get the FOMC meeting, so the Fed meeting where they make their interest rate decision. You're going to get the summary of economic projections, and you're going to get a CPI the morning of the meeting. So the meeting takes place at 11 a.m. California time. Inflation is going to come out at 5:30 a.m. California time. So you're whatever, 4.5 hours or whatever beforehand, you're going to end up getting, or 5.5 hours, whatever, you're going to end up getting the inflation report that morning. Now, some folks say maybe we'll be looking at the July meeting. Right now, July is fully priced for a rate cut. June's not. June's only at about 77%. But this would make sense because in June, you'll have February, March, April, and May CPI reports. Those 4 reports could offset a hot January. However, if all of those 4 reports are hot and they actually reiterate January, you're staying at these higher rates. Now, Citibank actually thinks there's a chance the Fed might have to start talking about interest rate hikes again, which would be wild, but I suppose it's possible if you end up getting multiple CPI reports that reiterate a potential acceleration again in inflation. Now, what's bizarre is we're not actually seeing this in inflation expectations. Inflation expectations coming in substantially lower over the last year. And not only are inflation expectations coming in substantially lower, but when you look at earnings calls of what we have with companies raising prices throughout our actual economy and what they're forecasting, you're not actually getting forecasts for price increases that would suggest growing or rising inflation. Here are the year ahead inflation expectations. You can see these here. 1 year ahead is this light blue number. 3 years ahead is the darker blue number. You've got stable 5-year inflation expectations, stable 10-year inflation expectations, which we can look at as either the 10-year break even, or you could go the 5-year forward. That's just a fancy way of saying what's inflation 5 years out and then the next 5 years from that point. All of these numbers are very stable, very anchored, which suggest when you combine earnings calls and inflation expectations, you suggest that the January number could be a one-off hot figure. It has been a wet winter, but it's been a lot warmer. We haven't had the snow this year like we've had last year. Or quite frankly, many years before that. Like if anybody out there is a skier, you're probably like, man, this has been a warm season. And it's not great. The snow hasn't been that great. So it's a little bit of a bummer. But what does that contribute to? More service spending, people getting their tax returns done earlier, people getting, whatever kind of services they need done earlier in the year than usual. And that can lead to pricing pressures consolidated into January. Now, that's just an idea. That idea does align with what Goldman Sachs believes. Goldman Sachs actually pulled off the estimate the best. They thought that inflation would come in at 3.8%. It came in at 3.9 for that core figure, so they were closest. And as you could see, Nick T suggested here, 0.38 again. I always kind of move the decimal there when I say this. But anyway, they had a quote, "We expect a temporary boost to core CPI from start of year price increases, which we expect to be most pronounced in prescription drugs, car insurance, tobacco, medical care services." We did see all of that. But what you also have to remember is housing disinflation still isn't really coming the way we expected it would. We've been expecting rents to come down, more housing disinflation. Instead, we just had housing contribute 67% to month-over-month inflation, up 0.6% from the 0.4% we had 2 months in a row. So you're now seeing those 3-month and 6-month numbers move up, which I write here, did the Fed know? I kind of think the Federal Reserve did know. Why do I think that? Well, because Jerome Powell refused to talk about the 3- and 6-month inflation figures in the last Fed conference until he was finally backed into a corner to talk about it. And he's only interested in that 12-month figure, which I think that's because he probably knew January was going to come in hot. Now, it is a benefit that Jerome Powell suggested, hey, the numbers don't have to be as good as they have been. They just have to keep trending down on the 12-month. And that's probably why they're going to wait until June for those first cuts. So this is just going to take some more patience. Again, with the super core coming in at 0.85, which annualizes out to 10.2%, which is insane. Nobody sees an additional 10.2% inflation right now on an annual rate, right? It shows you how extreme January is. It really shows you how bad this report was. But I'll tell you, who's it ammunition for? Donald Trump. It's ammunition for Donald Trump, and it'll be accurate ammunition for him. You cannot tell Donald he's going to be wrong by using this against Biden for the next, essentially month or potentially even multiple months thereafter, because it's going to push our averages up. That stickiness, that is what the Fed is most concerned about. The Fed is concerned about the shelf right here, that this number is not going to continue to trend down. It doesn't even have to plummet like it did here. It just needs to trend down to like 2.5%, basically to be around this level over here pre-pandemic. And any of this shelving, bad, really bad. So anyway, that gives us a breakdown on CPI. It was a bad morning. It's a bad report. It's not good. There's a chance it's a one-off, but that could be hopium. Either way, we're probably and realistically now looking at June or July. So in case you're wondering why a lot of stocks are red today, there you go. Oil up to 82.5 on Brent, gold down, Bitcoin dropped a little bit off its 50K. Rough numbers. Risk assets selling off today.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than House Act, nor am I presently acting as a market maker.